This video covers inventory items and basic concepts about inventory. We're going to be talking about inventory and cost of goods sold. Inventory is a current asset on the balance sheet. Cost of goods sold is an expense on the income statement. When inventory is sold, it turns into cost of goods sold expense. Inventory is carried on the balance sheet of the owner of the inventory. Consignment goods are owned by the original owners, not the company holding the consignment inventory. So consigned goods are not on the inventory of the company that currently has the inventory in their possession. It belongs to the original owners until those owners give up title. Inventory is carried on the balance sheet at its cost, and we're going to talk more about that. But we carry it on the balance sheet at its cost. So, talking about cost of goods sold and inventory on our financial statements. Cost of goods sold is commonly abbreviated COGS. We will find inventory on the balance sheet valued at its cost. Cost of goods sold is also valued at the cost of the items. On the income statement, we will see sales revenue, which is the selling price. So note that the cost goes up as inventory on the balance sheet and as cost on the income statement, cost of goods sold. The sales price or selling price is found on the sales revenue line of the income statement. Sales revenue less cost of goods sold is known as gross profit or gross margin. Note the difference between the sales price, also called the selling price, of inventory and the cost of inventory. In our example, sales revenue is based on the sales price of the inventory sold, which is $50 per unit. Cost of goods sold is based on the cost of the inventory sold, $30 a unit. The inventory on the balance sheet is based on the cost of the inventory still on hand, $30 a unit. The cost of inventory includes everything to purchase the inventory and get it ready for sale. Freight in is the transportation cost paid by the buyer. Freight in is accounted for as part of the cost of inventory. A purchase return occurs when a buyer returns goods to the seller. A purchase return represents a decrease in the inventory cost for the buyer and a corresponding decrease in its accounts payable because the company no longer owes the seller for them. A purchase allowance is a decrease in the cost of a purchase because the seller has granted the buyer a deduction or an allowance from the amount owed. The buyer keeps the inventory but decreases its cost by the amount of the allowance. A purchase discount is a decrease in the buyer's cost of the inventory earned by paying quickly. When we add or subtract all of these items, we will get the net purchases of inventory. Again, the cost of any asset, such as inventory, is the sum of all the costs incurred to bring the asset to its intended use, less any discounts. There are two main types of inventory accounting systems, the periodic system and the perpetual system. The periodic inventory system is a system where goods are counted by hand and then priced at certain intervals, like monthly, quarterly, or yearly. For example, a small local hardware store that has been in business for many years may not keep a running record of every board or nail it sells. Instead, the store might count and price its inventory periodically, at least once a year, to determine inventory quantities. The store would also keep a record of inventory purchased. In contrast, a perpetual inventory system uses computer software and barcodes to keep a running record of inventory on hand, purchased, and sold. When a business purchases inventory, employees run the items through a scanner which reads the barcode on them and adds them to the inventory count as well as to accounts payable. When items of inventory are sold, they are scanned again. The company's computer system records the sale, the cost of goods sold, and updates the inventory, removing the item from the company's records all in one step. By keeping a running record of all items purchased as well as sold, in addition to beginning and ending inventories, a company always has a record of how much inventory should be on hand. Then by taking periodic physical counts of inventory actually on hand, the business can compare the counts with the perpetual records. This helps the business track down inventory errors as well as theft. Because computers have simplified the process of keeping track of inventories, most businesses today use perpetual inventory systems. We're going to go through an example of purchasing inventory on account. On September 23rd, Robertson Corporation purchased $50,000 of inventory on account. We need to journalize the transaction. First, we will enter the date for the journal entry. Next, we're going to debit inventory for the $50,000 of inventory purchased. Inventory is an asset and it's increasing, which is why we debit it. The credit will be to accounts payable because we owe the vendor for the inventory purchase. Our final stop on this journal entry is to put the memo line in, and that is how you write the journal entry to purchase inventory on account. Selling inventory on account requires 2 entries. In our example here, on September 30th, Robertson Corporation sold $10,000 of inventory on account. This inventory cost Robertson $6,000. We need to journalize the transaction. The first entry will be recording the sale. We will debit accounts receivable for $10,000 and we will credit sales revenue for the $10,000. That first entry is to record the sale. The second entry needs to record the cost of the inventory that was sold and remove it from inventory, so we will debit cost of goods sold, which is an expense, for $6,000. We will credit inventory for $6,000 to reduce inventory for the cost of the items that were sold. So whenever we sell inventory, we need to make 2 entries. The first one to record the sale and the second one to recognize the cost of the inventory reduction. Finally, there are 4 main types of inventory cost methods. The cost method a company selects will affect the profits it reports, the amount of income tax to be paid, and the values of the inventory turnover and gross margin percentage ratios derived from the financial statements. I will cover these methods in different videos, but for now, know that companies have a choice about how they cost their inventories. The 4 methods are specific identification, average cost, first in, first out, and last in, first out. That's it on this video. This video is created and narrated by Dr. Wendy Tietz. Have a great day.